Last week, we have seen for the first time the Fed's future funds priced in negative rates for both November 2020 and January 2021. And as the oil production is crashing, negative rates basically mean a death sentence and a deflationary collapse for the global economy. A deeper stock market crash is about to come. Thomas Barkin, Richmond Fed president, has stated loud and clear that he thinks it is not worth it to try negative rates in the U.S., as he declares that he thinks negative interest rates have been tried in other places, and he hadn't seen anything that could make him think they're worth a try in America, adding that if we looked at the recent data, we would see it as low as it would go, affirming firmly that eventually people will be brought back to work and hopefully they will be back to stores, and within weeks or months, he expects this data to go up from where it is. As we have continuously addressed in previous videos, the idea of taking the economy back from where it was left off is not a realistic plan at this point in time in history, so it seems that he doesn't actually have a plan, as this was his response to a dramatic move that echoed across asset classes, in which 2Y yields plummeted to record lows, while stocks and gold skyrocketed, making markets finally acknowledge that negative interest rate policy is likely to come in the next months. Either way, looking at the Fed's funds after Barkin's statement, we can see that the market hasn't been given much attention, with December implied rates still in negative area. With that said, it seems that the only way out of this mess would be if Powell handled this situation without any delay, reversing the market's test of the Fed's resolve from zero interest rates policy to negative interest rates policy. However, he has to take action immediately. Otherwise, if the negative rates become even more accepted and Powell utterly denies it down the road, making it look like a hawkish reversal, that could potentially lead to another crash in the market. And even with the Fed debating that nobody could have predicted that this was coming, ultimately it will be forced to cut to negative rates anyway. That's precisely what BMO analyst John Hill has been defending, saying that with certain Fed funds futures contracts now trading with a negative implied yield, Powell needs to decide whether he wants to nip that possibility in the bud. If the FOMC drags their feet too much, they run the risk of creating either a self-fulfilling dynamic and/or having to effectively implement hawkish Fed speak later down the road. In addition, he'll forecast that a cut into negative territory remains unlikely. On 3 separate occasions during the last press conference, Powell referred to the current target range as the effective lower bound, implicitly acknowledging that any further reduction in the target range would be self-defeating. But even so, the market doesn't seem to agree with Powell's resolution, and investors are currently pushing the negative rates trade for later November. If Powell neglects to address the situation quickly, over time more and more proximal Fed funds futures will violate the negative interest rate policy lines, to the point that the market becomes sure that negative interest rates policy is not only permissible as it is priced in. By that time, it will be terribly late for Powell to intervene. As we could analyze from the latest episodes, once another negative reaction happens in stocks, the Fed's chair is likely to have a breakdown. If it isn't in his plans to inject further $2 to $3 trillion worth of quantitative equities, because by now, as estimated by Deutsche Bank, that would be proportional to catching down the -1% R-star, his only alternative would be to admit that the US has joined Japan and Europe in the monetary gray area. As a matter of fact, the euro-dollar market has already started to panic. Many analysts have been saying that with the Fed fund futures climbing to contract highs, it's expected that the first priced negative rate switches from January 2021 to December 2020 tops, setting the next market test of the Fed, with bonds, stocks, and forex pricing negative rates within less than 6 months from now. remembering what happened in 2015 when the Fed has started to deal with its first tightening cycle in over a decade, being set to raise rates for the next 3 years. They were warning that elevating the rates would be a bulky policy error because back then the R-star, or the natural rate of interest in an economy where total debt GDP was 350% and rising, and where GDP was 2% and falling, the short-run equilibrium real interest rate was the paltry 0.57%, which also meant that any attempts to push rates notably higher, as the Fed was doing then, would result in catastrophe, forcing the Fed to promptly cut rates, if not go negative, as stated by a high-profile economy website. Nowadays, the U.S. debt is considerably more prominent, and the GDP growth has been compromised and is now collapsing, setting sharply negative lows. Then, of course, the R-star is way lower than it was in 2015. Even the Deutsche Bank has affirmed that the Fed has a lot more to catch down to R-star, with its credit strategists examining that the Fed's massive intervention wasn't enough to achieve this on its own. Stuart Sparks, an analyst from Deutsche Bank, has even alerted last month that there were ample evidences that this policy would ease further in a variety of asset markets, as he maintains that one of these is the currency market. The trade-weighted dollar is stronger than it was before the sanitary crisis, and is stronger than it was when effective funds were more than 225 basis points higher last year. Another clear reflection of further need for policy easing is in commodity markets. Oil has nearly monopolized commodity-related headlines, but are only part of the story. Agricultural commodities and metals are significantly lower on the year. We can see this in break-evens, where our model fair value is roughly 1%, and clearly nowhere near the context of Fed policy objectives. He goes on by reviewing that the market dynamics still indicates that the policy is too tight, and with an investigation done by economy expert Francis Yared, assessing that R-star is roughly at -1% using data from equity and fixed income correlations, the DB specialist deduces that alongside this information and treasury yields, it's possible to infer the level of R-star implicit in market behavior. That is to say, regardless of everything the Fed has done so far, including the evident trillions spent in liquidity injections and backstop fundings, the equity hasn't much of a choice other than cut its rates to negative, so that would counterbalance the suppressed market imbalances. In parallel with Deutsche Bank's evaluation on this matter, Andreas Nano-Larsen, Nordea's forex strategist, has boldly stated that in accordance with the bank's model, negative long USD yields could be the name of the game, pointing out to this chart, which compares 10Y Treasuries with its alleged yield using statistics from the global business cycle, inflation, Fed funds, and the Fed's long-term dot. To summarize, not only the short end will turn red, as the entire curve will turn negative sooner or later. Meanwhile, on a Project Syndicate article written by Ken Rogoff a week ago called "The Case for Deeply Negative Interest Rates," he invites us to imagine what would happen if, rather than bolstering the market only by using guarantees, the Fed could push most short-term interest rates across the economy to near or below zero. Europe and Japan already have tiptoed into negative rate territory. Now suppose central banks pushed back against today's flight into government debt by going further, cutting short-term policy rates to, say, -3% or lower. The result would be completely catastrophic, since banks dominate everything in the US, and that would affect not only the rest of savers, as well as the banking sector and consequently the whole US economy. Given the fact that there's nothing we can do besides sitting and watching, the only thing left for us is beholding how this final strike is going to be conducted. All in all, Bond King Jeff Gundlach has encapsulated the whole scenario in a nutshell when he tweeted, These trillions the Treasury is borrowing is heavily in T-bills. Chair Powell has stated in plain English he's opposed to negative interest rates. Yet the pressure to go negative on Fed funds will build as short-term borrowing explodes and dominates. Please, no. Rates less than zero, fatal. In conclusion, after all this storm of comments about negative rates, Bloomberg WIRP function has shown the record-breaking mark of negative 0.02% implied rate of January 2021, demonstrating that the market has finally yielded. For this reason, the amount of bets on negative interest rate policy by end 2021 has been escalating, and ultimately the market has managed to break down the Fed's argumentation regarding the imposition of negative rates.